For those that are joining us, thanks very much. Welcome to the Nest Edge. This is a monthly chat that Sean and I do every month, and we talk about several things. The reason that we name it the Nest Edge is because we have a unique way of looking at data, and it gives us an edge over the choppiness of the markets and the news cycles. First thing I want to do is put the disclaimers out there. This is not advice. We are financial advisors, but this right now is not advice. This is an educational webinar. Use this education to make more informed decisions. And again, this is how we do things in this game of investing. There are many, many ways to lose, and there are many, many ways to win. We are discussing our process and why we think it's better. For those of you who have listened to our webinars before and would like to move forward in building your portfolio with us, please reach out to us at info@nestfinancial.net, and we'll be happy to walk you through the process. I read recently where every one of us knows 152 people on average. So if someone in your circle needs to grow their knowledge in the financial area or arena, please send them our webinar links. This is how we introduce ourselves to new clients through our works and our conversations. All right, Sean, this is a conversation between you and I and inclusive of our audience. So if you have a question, please make sure to add it to the Q&A box. That's what I'm looking at right now. Sean, good to see you.
Good to see you as well.
I want to start off by talking about, and what we always do is the newsletter. The 60-40 model is dead. It's a really interesting topic because it talks about the heart of what and how we do things at Nest and how we invest in completely different than what the majority of advisors and their portfolios are out there. So we want to go into these questions more setting up the story as what is being done and why we think that's no longer valid and the points that we want to make. So first, Sean, let's discuss a couple of fundamental facts about the financial industry so that we can set up this conversation properly for the audience. You and I, even though we're a decade apart in our training, we're initially taught the same way. And this is the basics of what has been taught for decades. Modern portfolio theory, asset allocation, all of these things. Can you talk about modern portfolio theory and the efficient frontier, what that is and what we learned?
One and the same. They're parts of each other. It's how do you maximize your gains with the risk that's appropriate for the investor. It's that's the short answer of it. It's a very old academia slogan that has these papers that was done on it, and it uses a lot of the average of things, which I'm generally completely against. But that's the short answer. Probably don't need to do a dry erase board and share the math of it. Even the efficient frontier, I had to remember that language. Gloria probably knows it better because she just went through CFP hell. But it's
congratulations, Gloria. She passed. So we have another CFP.
Yeah. God bless you. I had nightmares, but I was anxious all day when she was sitting for it. I was just like, oh, what a terrible, awful, stressful day. All that being said, it's an old theory, academia kind of put together, and on its surface level, it has a good idea, and it's better what was done before, which was nothing really to that scale. But it kind of, a lot of people bought into it, and it got really, really popular in the last 20 or 30 years because compliance officers love it. Right. It's a CYA thing. It really helps. Like, whoa, look, the process that we do is this long-standing, efficient frontier market hypothesis.
I'm not sure I understand.
What?
Well, Siri doesn't understand that either.
Exactly. It makes no sense. Siri.
Did you do that on purpose, Sean?
No. Did I say Siri? I don't think I did.
No, I think maybe it's just
my watch grabbed it for some reason.
Language. Yeah, no, to your point, this, and I want to paint a picture for the audience. This is 1952 when Harry Markovich came up with this efficient frontier. 1952. Now think about what stock. So I want to go back to financial planners, financial advisors back then. were non-existent. They were stockbrokers. That's what it was. You buy stock, sell stock, and you're making money on just that. So the whole industry has evolved over years and years and years, and more people wanted to figure out, how do we not just pick the one stock, but build something like an entire portfolio. And so, to your point, this is what we were taught and what we've been taught for decades. So, as you pointed out, in theory, it sounds right. But to continue to set up this history lesson, and where the next step is, we were also taught asset allocation and portfolio models. That basically means weights towards stocks, bonds, and cash. Thus, the introductory to the 60-40 model. And one of those weightings is stocks 60 and bonds is 40. Other portfolios are like the 80-20, more aggressive. That's what that is. Or a 45-45-10, which is like at the middle of the road. So it sounds good on paper, right? But Sean, what does that ignore?
Oh, God. So much. I mean, the easy answers I brought up in the little article was, commodities and currencies, the two massively important markets. You're just completely ignoring those. And in my opinion, you're doing it backwards. When you build these set canned models, you're from the top down, you're saying, no matter what, we're going to have 60%, then 40%, and we'll figure out what the 60% is later, instead of the bottom up is an easier way to look at it. Like, well, what makes sense now, what's doing well now, and then let that determine what the 60 or 40 or 30 or whatever it is going to be. It makes just a little backwards, in my opinion, and how I view things is, why are you forcing yourself to have 60%? Because the average of the time it does X. Like, it's not about the average. It's about the particular time and space, like the actual data. And if you start playing the averages game and living and dying by it, like, you're going to get surprised a lot.
Yep. And I want to point out again, this was 1952 when this was built. These are the ideas, and everybody just jumped on board. And I told the story in our last webinar, and I tell it again because it is something that, as human nature, we get used to things. So the story about the 3 or 4, let's call it 4 generations at Thanksgiving or Christmas dinner, and they notice that there's a ham going in the oven, and the mom cuts off both ends and throws it on the pan and puts it in the oven. And the daughter asks, "Mom, why do you do that?" And the mom goes, "Well, I don't know, but let's go ask Grandma." And so Grandma goes in there, and she didn't know either. But Great Grandma's sitting in the couch. So they go ask Great Grandma, and Great Grandma starts laughing hysterically. And she's like, "Because my oven was this small, so I had to cut the ham." But the whole point of this was that as humans, we just do things forever until otherwise proven, or somebody asks questions. And that's what we're doing today. This theory was started in 1952. Again, financial advice, the whole industry was different. We didn't have internet. It wasn't a global economy back then. So there was, today we have global economy. We have computers doing the trading. We have tech companies that take off to $1 billion valuations overnight. We're in a completely different world. And that's just, we're just kind of painting this picture as to why you don't stay with old theories, and you got to look at other data, and that's what we're about. So we touched on some of the overall issues, and we'll get into that more. But what I want to do is address the whole lazy part of this portfolio. So why do we call it that, Sean?
Because it's lazy as hell. It's lazy. You're doing what you're told. And this is my biggest complaint about my peers, is that a lot of them just don't think for themselves. They just, whatever firm they come up in, whether that be technical or fundamental traders, or however they're taught, or whatever methodology, that's just what they do. And they don't think for themselves. They don't like, well, does this really make sense? Is there anything better? Should I be looking for a different resource or a different point of view? A lot of them just kind of like settle into something, and then the bad actors really take over, because the goal is to, increase your AUM as much as humanly possible, make as much money for yourself as much humanly possible. And
I'm gonna make definitions for the audience. AUM is assets under management. So they go out and get new clients. But continue.
Yeah, it's just you make, like, for example, and this is a heated debate that I don't even bring up anymore with, like, I have some study group members that believe in all this crap. They're like, this is what they do. They will construct one model for their aggressive growth model, and it will stay that way for their entire careers. There's no thinking about it. There's no macro analysis. There's no technical fundamentals, nothing. They will have a pie chart for aggressive growth, and that's the way it is. And then they just turn around and then try to sell that widget. That's it's just lazy.
Yeah.
And it's just, it breaks my heart that people pay for this, because you could go get that for free, for sure.
I was going to add to that. I call it fill in the blank models, because essentially you've got, essentially it breaks down the models 60-40 and the other ones as well. And they say this is much in international, this much in this. And so it gives you the entire model. And all you got to do is find managers out there, portfolio managers that do that piece. And you just plug and play, and then you let it go. Maybe a year later, check on the returns. And if you have a better manager, you switch the managers out. And that's about as much work as getting done. The rest of the time, they're spending on hobbies and acquiring clients at the end of the day. And so that's not, obviously, that's why we call it, at least I wanted to address that. Now, the nitty gritty as to why it's dead, because I wanted to set up the story as to how things are being done, so that the audience understands that this is how we're trained, and this is how long it's been around, and this is why it's done. But to the nitty gritty, let's talk about why this model or models or this way of things are being, these models are way of doing things is dead, in our opinion, and their days are numbered. So in your newsletter, you mentioned a few things. One of the things, let's touch on those 4 markets and then the economies of the various countries. I think those 2 things are important. So instead of stocks, bonds, and cash, the other 2 models you already mentioned, commodities
and currencies
are largely ignored by these models.
Yes, completely.
You can't set those up. You can't set a currency in a asset allocation model that'll be there for. You can't put a currency in there forever. I mean, this is like.
I mean, you could. It would just be stupid, because there's things. There's certain things come in and out of favor. Yeah. And you just don't want to, you don't want to be long the, British pound indefinitely. Right. It takes active management to kind of control that. And the same thing with commodities. You don't want to be long corn forever, like have been fading out of the last few weeks. Mm-hmm. It takes active management, and that's when it gets harder. I know I'm bouncing around. I just when you ask these questions, my brain just goes zzz, and I'm like, which one should I talk about? Because there's tons of layers to it.
The other thing is countries, right? Because so going back to the model, and I'm just going to going back in the model is this international exposure, small cap, large cap. Boom. That's the section that you've got to fill. Fill in the blank, and most people will just pick a fund and throw it in there. Yep. But we do that completely different when we're doing international exposure. Talk about the economies of the various countries and what we look at.
I mean, it's exactly the same thing how we do here, how we view things, which is, a quad environment. What's the rate of change of growth and inflation, and specifically how fast or slow is that rate of change happening? So we want to figure out where we are, where we're going in our domestically, but then also every other country, the top 40, I'd say. We don't get too deep into the weeds, and there's some really, really exotic markets I kind of stay away from. But we're looking for economies that are on the up and up, and we want to have exposure in those, areas. Like, for example, right now, you don't want to be long China. It's getting hammered. We were in it. We got out of it a few months ago. And so you just have to know where they are from an economic. Are they expanding? Are they contracting? What's growth and inflation doing? You don't just buy and hold on for dear life forever, especially in emerging markets here. You get your face ripped off.
Well, I really love how you pointed out in the newsletter how just ignoring those 2 markets, which is commodities and currencies, you're ignoring half of the market. We get all this data, and then the work begins. We got to figure out what's what. The contrast that I want to make, or the distinction that I want to make between asset allocation model and what we're doing is countries don't go in and out of favor on a year by year basis. It's not like you can set it and forget it. There's 3 or 4 months that they're really hot, and then you got to go. And as a good example of what you've been saying, and I think you mentioned this in our last webinar, some of the things that we're long in. I know some of the portfolio reviews with clients. You've said we're long these specific countries because, let's take COVID, for example. U.S. launched out of COVID and grew exponentially. The economy did, right, much sooner. We opened up much sooner. Some of these other countries are still under lockdown. So the growth that we experienced in the U.S. is going to happen in some of these other countries in the next month or two. And we want to be exposed to that for a period of time.
Yep. Germany, Netherlands, Switzerland, like they're just lagging. They're opened up slower. We still have exposure there. And then like things that we've been, our models I've been telling people, like, I don't know when, but the models are going to start slowly rolling out of the things we've been in for closing in on a year. We're almost completely out of corn. We're no longer short gold. Their financials were starting to fade out of that. The back test is changing. The signal is changing. So the things are moving around a little bit. This is when it gets kind of tricky. We've been positioned the same way for a while now.
Yeah.
And I don't know for sure which way we're going or where we're going. I know inflation is should continue to still keep moving upwards, but the growth is going to start cooling.
Okay, I'm going to pull you back in because we're going to go back into the whole 60-40 model.
Sorry.
In your newsletter, you mentioned a glaring example that's killing the 60-40 right now, and that's bonds treasuries.
Yep.
So can you elaborate, on
they're so low. The yield's so low. What's the 10-year yield right now? And we're focusing on the 10-year yield just because that's the largest component of that. Most of those cookie cutter models. The 10-year yield's at 1.36 right now. Mm-hmm. PPI or the inflation report for PPI just came out. Where's it CPI that just came out? What came out yesterday? It was 5.4 year over year. And so, all right, just simple math. You take 5.4, that's what inflation's running at, and you subtract out the yield of 1.36, you're getting slaughtered. And like there's so much pressure to keeping that yield down. It sucks.
So I do want to talk about this in a story until time, because this makes sense. If you've got 40% in your bonds and the safest bonds out there are earning you 1%, that's not how the theory or not how asset allocation was built back before. It was bonds were supposed to be that stable part of your portfolio, but still making you money and outpacing inflation. I remember 2000, 2001 timeframe. I was working with I was at Merrill Lynch at the time. And these were some older clients that I had inherited. And they invested in CDs. I think they had like $2 million in CDs. And it was time for them to renew. But at that time, Sean, interest rates were 5%. So they were making $100,000 a year. And that's the income that they were making on that $2 million. And so they were, happy with that return. They came in and they said, okay, it's time to renew these CDs. And at that point, I believe the rate had dropped to like 2%. So think about your income going from $100,000 to $20,000 at your renewal time period. And so the point here is that I can't remember from that point forward where we've had healthy returns or in the bond cycle. Because you think about 2007, 2008, we've struggled to find bonds that have, and I say bonds, I talk about CDs, bank rates, all of these things. When was the last time that someone had 4 or 5% return on their CDs or
CDs? I don't even remember that. Yeah. It's been a minute. You're not going to get the easy money anymore. You got to go deeper into the weeds, into junk to find, yields that are that high. You got to pay for the risk, and everyone's just crowded into these safe positions that it's hammering the yield. So it's not as easy.
It's been tough for a long time to find yield. And this is why we're talking about the 60-40. If 40% is going to be in bonds, and you're like, well, okay, we've got to find something that's going to make money, and that just does not work. I liken that to the example of if you think about your portfolio as a dog sled, right? And you have all these dogs that are pulling the sled, and you're doing this. You have your stronger dogs, which are your stocks, and you have your work dogs that are your bonds. That's the way that that works. Those are usually behind the pack. Not today. It's like having your strong dogs out there, and then the other ones are riding the sled because they're just pulling the weight down. So that's just the example there. So a couple questions from audience. Let's stop here and talk about that real quick, because I know we're getting kind of running out of time here. So this has been an interesting conversation.
Real fast. We can talk much longer than 30 minutes on this.
For sure. So 60-40, if the 60-40 isn't the right ratio for proportioning investments in stocks and bonds, what's a better ratio? That's a question from the audience.
Yeah, I touched on this earlier. You can't look at it from the top down. Like, that's just because then you're already like, how do you define that 60 on the top? You need to let the individual positions control what you are. Manage each position separately from each other.
In the economy, and I want to add to this, because think about how, what would have a 60-40 portfolio done for you in March of last year when the stock tanked 34%, right? You would have also just rode that roller coaster down, on both sides. And so, so that's ratios that.
Sorry, I keep cutting you off.
I was going to say the ratio. That's why that ratio thing is not. You got to look outside of that. This is the answer.
It's going to change. Yeah. I mean, there's times when you want to be 80-20. There's times you want to be 50-50. And you don't set it on the front end. You don't go 60. All right, I want to be 60-40. Now I got to go fill in this 60% with, the things I like. It's the opposite. You got to manage each position independent from each other. And then after you're allocated, then you figure out I'm 40%, the growth model right now is 43% equities, 13% commodities, 20% credit, and 24% cash. And that weighting, I didn't come up with I didn't go, I want to be 40% equities and then go allocate to the things. No, each position, you need to what is your max min exposure you want per position, and then figure out, your floor and your ceilings and stuff like that. But each position is separate from all the others. The only thing that have in common, and you still is just what's growth and inflation in doing? Does energy like that? Does materials like that? Does financials like that? It changes your menu depending on where we are economically. When I say change your menu, it's what do we want to have? And then you look at those positions. All right, so growth and inflation are ripping. We like these things historically. What's the signal saying? Just because the back test says it's going to work doesn't mean it's going to work. That's another, lost cause that you see common, 73% of the time when this happens. So you trade on that alone? What? What's it doing right now? Because just because something should work does not mean it's going to work.
It's always evolving, for sure. Another question from the audience. Saw an article on I-bonds. They said they're linked to the CPI, ? I would think that would probably tip bombs. Tips,
I guess
probably.
I-bonds?
I would think those are tips, maybe?
It's yes, there can be correlations with, I'm just going to just say bonds in general, with inflation and bonds. There is a correlation, but it's not always the most important one. And it's how do you define the CPI thing that's inflation? So the dollar matters in there, but then also what is growth doing? It's never there is a mistake made when you try to say, if this happens, then this happens. Everything doesn't have a guaranteed correlation, and correlations form and disappear. They come and then they go, and they don't become a matter, and then they matter. So the articles that try to create these shortcuts and these, stories to where when this happens, that happens. I think I'm seeing what these questions are now. I just thought there would be a way to improve the bond yield. I think they're legally. I guess I would need to talk to him and see exactly what I-bonds he's talking about. I don't understand the question. We'll follow up with you.
We'll follow up for sure. Lastly, I want to touch on this. We've got 5 more minutes. We have 5 models. How are they different than your typical 5 models that are out there. I know we've talked about our processes, but we still classify 5 different models.
How are they different from each other or from the generic 60/40?
Generic 60, the generic models. And I can answer this. I was asking a rhetorical question, but
okay. My wheels started spinning again. Like, oh my God, I'm going to talk for 10 minutes.
Yeah. So the models are different in that we specify a rate of return that each one is the goal for. So what we're trying to do is manage risk, and the way we manage risk is say, okay, our model, our model. Our protective model, our income model that is made for income, we're shooting for 6% goal. And that's the goal. And we're going to make that goal or beat it with the least amount of risk possible. And then it goes from there into the other models. And each one has a stated rate of return that we're trying to achieve versus just saying the model is this, and we got to compare it to other models that are doing this. And if we ride that roller coaster, and whatever that roller coaster lies, if we've beat those models, then we feel good about ourselves. And if we don't, then we got to go back to work. Much different than that. We're not riding roller coasters back and forth. We're just like, this is a specific rate we're trying to achieve. Makes it much easier to do planning around, because clients' budgets don't go all over the place. They need a specified amount of return to meet goals, and they meet whether that's income or whether that's growth in their investments. So that's what I meant by how our portfolios are different. So I think that
well, I saw the follow-up of the question. Looks like he's talking about tips.
Yeah.
That's true. There are tips out there that U.S. issued tips that we're long some of them right now because of the inflation play. But there are times, you don't want to be them if it's going the other way, which is,
and
environments.
The challenge with that is the stated inflation, right? Because they're linked to a stated inflation that may or may not be what the actual inflation is. We talked about this in the last webinar. If they're politically saying inflation is 3.8 and we're really looking at things, it's much higher, then, they may help to keep up with that, but it's the stated inflation.
I saw another question in here that was shot on there before we got going. Where was it?
I've already included it. That's the first one I asked.
It was about how to balance returns, downside protection, and how to balance returns with downside protection. You have to. So there's no silver bullet perfect way to balance the two. You just have to have layers and layers of risk management. It starts with understanding where we are economically, where most probable place that we're going, what does well in those environments. So that right away, it helps you to know where to be, and most importantly, where not to be at the individual level. And we've got a minute left. Figuring out what's your max exposure you're allowing to hold in that position, and what's your minimum exposure. And then once you figure that out, then you got to build what's called a risk, trading range using price, volume, and volatility. Those are the major components to kind of figure out how to trade around that one. And that's the real quick, with only a minute left. I don't know how to say that faster, but there's no one single tool out there to balance downside and upside. You just have to have layers and layers and layers of, risk management to understand, all of our models are trying to get a goal with the least amount of risk possible. So that is,
Yeah, and for those clients that have been with us, they saw what happened. The most volatile year we've been through is, 2020, and when the market fell 30%, none of the portfolio models that we had fell. They were all stable because we had moved all of that into the models, treasuries and gold, and so we had that in place.
Coasted through it. Yeah.
Alrighty, so that is our time today. Once again. Thank you very much. This isn't investment advice, rather a conversation, as you guys saw, between how we do things and what we look at. If, however, you'd like to discuss how we do things or interested in anything else, please let us know. We'd be happy to help. If after this you want the recording, it should be in your email box. We should, within the next half hour or so. And please share it with anybody that you think it might be useful for. Thank you very much. Take care.
Adios.